Hey everybody, welcome back to another edition of 5 Question Friday. This is where I do my best to answer your questions. We've got 5 great ones today. Let's dive right in. Here's what we're going to be looking at. Number 1, should we think of dividends, particularly that we get in a taxable account, as guaranteed income? It's question 1. And there's also a second person asked a related question regarding dividends and safe withdrawal rates. We'll look at that as part of this first question. Then we'll look at, should we invest money in a health savings account in the same way we might invest in a Roth IRA? That's question 2. Question 3, how should we pay taxes on a Roth conversion? Should it come out of the converted amount, or should we find some money in some other source, a taxable account, to pay the taxes? And does it matter? Number 4, should we get long-term care insurance? How should we think about that question? And then number 5, should our investing strategy change as our wealth rises? And the viewer particularly wants to know about alternative investments that some folks have been promoting to them. So those are the 5 questions. So let's dive right in. Question 1, should we think of dividends as guaranteed income? Now, as an initial matter, dividends are never guaranteed. A company can cut or eliminate their dividend if they want to. And that's true, of course, even if you own, like we do, index funds, which comprise, often thousands of companies. It's probably pretty unlikely that every single company, say in a fund like VTI, which is Vanguard's total U.S. stock fund, kind of hard to imagine that they would all eliminate their dividend at one time. But there certainly can be economic conditions where the amount of the dividend could go down significantly. If we think about the Great Recession, the financial crisis, 2007, 8, and 2009. I think the auto industry completely cut their dividends. I believe banks, of course, cut their dividends, eliminated them. And so dividends definitely went down, but they weren't completely eliminated. And I think if we go back to the viewer's question, that was sort of their idea about, well, maybe I'll assume I can count on 75% for planning purposes. And so with that idea, I really have two thoughts in mind. First of all, I don't view dividends as income. I understand why many people do. You get that quarterly, deposit into the cash account at your broker, and it feels like income, right? But really all it's doing is transferring money from your investments into a cash account. You're not reducing the number of shares that you own, but you are reducing the value of those shares dollar for dollar when a dividend is issued. And so I don't think of it as income in the same way I might interest on a bond or interest on a savings account or a certificate of deposit. Having said that, for planning purposes, I get it. You're trying to figure out how you're going to create your retirement paycheck, so to speak, and where that money's going to come from. And you see these dividends coming in, let's just say every quarter. And just for, if nothing else, planning purposes, can you count on those? And I believe generally you can. Again, there are going to be economic conditions where dividends will absolutely go down. And here I'm talking about absolute dollars. The dividend yield is going to change every day as prices go up or prices go down. But the actual amount of the dividend could go down, and it has in the past, when we have significant economic, issues and crisis. So that will happen. I think the viewer's assumption of maybe for planning purposes, can I at least assume 75%? I think that's reasonable. Of course, it's no more of a guarantee than any other number, but I think that's reasonable. We could try to go back at history and kind of figure out what the worst case has been. Of course, that won't tell us that tomorrow won't be even worse. So the long and short of it is, I don't view it as income, but I do think, at least for your sort of market index funds that generate a dividend, it's pretty consistent and pretty stable. It can go down and will in difficult economic times. But for planning purposes and how you're going to generate your income to live on, I think relying and counting on the dividend is reasonable. If you want to reduce the amount by some percentage, like this viewer did, down to 75%, just for planning purposes, I think that's reasonable as well. Okay, great question. Now, I mentioned this was a two-parter. Let me show you the second question. And here it is. Given the research on safe withdrawal rates that seems to be done using total return historically, if a retiree can live off their current dividend income without selling shares, and given that dividends tend to hold up fairly well, even in stock market declines on an index fund level, how would that alter the safe withdrawal rate? And I believe the answer is it doesn't alter it at all. The safe withdrawal rate is what it is based on a host of assumptions we have to make. How you're investing your money. How are you rebalancing? How long of a retirement are you assuming? Are you assuming an annual adjustment for the rate of inflation? Are you paying investment fees, and what impact is that going to have? Once we make those assumptions, and assuming we're going to use historical data like Bill Bingen did in 1994 in his paper that got us the 4% rule, we're going to calculate a safe withdrawal rate, and it's going to be whatever it is. If it turns out that you just want to live off your dividends, maybe you have some Social Security, maybe a pension, and you've got your basic market portfolio, the dividend rate is going to be significantly lower than the safe withdrawal rate, I believe, in the vast, vast majority of cases. Even if you're an early retiree, the dividend yield now, particularly if you have a somewhat stock-heavy portfolio, you're just over 1% on U.S. stocks, a little higher for international stocks. Now, you may have some bonds, and they're doing better. So maybe you end up in the 2 to 3% range, but that should be lower than the safe withdrawal rate. Regardless, they're really two different things. You can choose to just live off your dividends and not sell shares. That may be a perfectly fine approach. But that's not going to change what the safe withdrawal rate is based on all of the assumptions that are relevant to your specific circumstances, and of course, how you calculate it. Do you use historical data, or do you use some form of Monte Carlo simulation? At the end of the day, the safe withdrawal rate is going to be whatever it is based on all those assumptions, and it's likely going to be, I think in most cases, higher than simply living off the dividends. Now, if you have I'll call it an unusual portfolio where you have covered call ETFs and other kinds of, I'll use the word exotic investments, where you've got these high dividend yields, and in many cases, they're not really dividends at all. They may be option premiums. All bets are off. That's a totally different kind of portfolio. And so I guess my answer to the viewer's question is assuming that you don't have that kind of portfolio, that we're talking about a basic market portfolio, most likely index funds. Maybe you have some actively managed funds too, but that you're basically investing in the market as a whole, and not some of these other financial products that seem to have come into the discussion over the last few years. All right, great questions. All right, next question. Should we invest our HSA the same way we invest the Roth IRA? And they specifically ask, should asset allocation in an HSA account be different from a Roth IRA account? Great question. So as longtime viewers know, my view is we want to put stocks in a Roth IRA because we want it to grow, I like to say, as my mom used to say, fat as a tick, although she wasn't referencing a Roth IRA, but that's a whole nother story. But the idea is we follow all the rules. It's tax-free, so we want this account to get as big as possible. So let's put in a stock index or some sort of stocks or stock fund. For me, assuming you're using the HSA for retirement savings, it'd be different if you plan to spend it every year for healthcare, a perfectly reasonable decision, of course. But if you're a long-term investor and you're saving it for retirement, maybe for healthcare in retirement, but it's for down the road. Yeah, I invest the exact same way in our HSA as I do in our Roth IRAs, which again, for us is a stock ETF or mutual fund. And I think I think it's an appropriate approach for the same reasons that we do it with the Roth. We want the HSA, to get as fat as a tick. Now, I will say there are some fundamental differences. An HSA is, other than for a spouse, is not a great account to inherit, unlike a Roth. So you kind of have to manage the balances in your HSA and think about how you're going to spend that money. Our plan is to continue to save in the HSA and invest it at least until we start paying for Medicare, is our current thinking. And of course, it could be a way, and this is going to come up in another question in just a minute, to pay for health care down the road, maybe in place of long-term care insurance policy. But the point is, I do think you need to give some thought to how you're going to use the HSA and just keep in mind that it doesn't function the same way as a Roth IRA, but still, from my perspective, if you're a long-term investor using it for retirement, I invest in it the same way that we do the Roth. That's at least our approach. All right, next question. Here we go. Why does it matter where you pay conversion taxes from? I don't see where it would be any different on the total portfolio. And one of the things I like about this question is it allows me to use the old electronic whiteboard on my iPad. So here we go. So let's imagine, and of course it doesn't come up. Let's give that another try. Maybe this time. Yeah, one more time. If it doesn't work, I'll just have to describe it to you. Let me take it out. You know, it worked before I turned on the video camera. And no. There we go. All right. So we can imagine we've got an IRA, and we'll just put, just to make the math easy, we'll put 10 grand in it. And we're going to convert it. We're going to move it over to the Roth here. And let's assume the taxes on the conversion will be $2,500. And let's assume in a taxable account could be checking, let's say, we just happen to have $2,500. So we have two options. When we move this $10,000 over to the Roth, we can pull $2,500 out of it to pay the taxes, or we can move it all over and pay the taxes from our taxable account. So what's the difference? Well, let's imagine we first pay the $2,500 out of the converted amount. That's going to leave $7,500 in the Roth. And we still have this $2,500 in the taxable account. We could invest it, right? Put it in a stock index fund or whatever. But the downside to this right here is that we're going to have any interest and dividends will be treated as income every year that gets distributed. And then down the road, if we ever sell it to spend it during retirement or what have you, we'll pay tax on it, or any capital gains will be taxable. So that's the problem with it. If we instead, imagine we convert the entire $10,000, we leave it alone, we don't pay the taxes out of the converted amount, and instead we pay the taxes out of this $2,500. So in both cases, we have $10,000 left over, right? The first time we had $10,000 split between Roth and taxable. In this scenario, we have all $10,000 in the Roth, and we don't have to worry about annual interest and dividends and paying tax on it. And assuming we follow all the rules for a Roth IRA, when we pull the money out, we don't have to pay any taxes on it. And so that is the advantage of paying the taxes out of a taxable account on the conversion. And here's the other thing to keep in mind. You may have heard that the benefit of a conversion gets greater and greater the longer the money stays inside this Roth IRA. Well, that's true if we pay the taxes from a taxable account, because we're getting the benefit of not having to pay interest and pay taxes on interest and dividends every year from this account, and then ultimately the capital gains. And so it is true. The longer it stays in there, the greater the benefit. But if you pay the taxes out of the converted amount and only put $7,500 in, it's really not true. It doesn't mean that doing it this way couldn't be beneficial, because some folks may say, Rob, I appreciate this. I don't have money in my taxable account to pay these taxes. Okay, the conversion can still be a reasonable choice, so long as the taxes you pay at the time of conversion are less than what you would pay down the road if you didn't convert, and 10 or 20 years from now or whatever, just started taking distributions from your IRA. Of course, that can be a hard calculation to make, and there's always some guesswork involved. But at the end of the day, to answer the viewer's question, how you pay the taxes matters. And if you can pay it out of a taxable account, that's the best option. That's the best option. At least that's my take on it. So great question. All right. Question number 4. Here it is. I'll just show you on the screen. Are you getting long-term care insurance? What is your take on it? Is it worth getting if your net worth is $2 million? I found this interesting article from the Wall Street Journal. It may require a subscription. I'm not sure, but I will leave a link below the video. But I can tell you one of the key takeaways from that article was that, guess how many people have long-term care insurance? What percentage of the population? I was surprised at this. About 10%. It's not a lot. And one of the reasons, no doubt, is long-term care insurance is very expensive. That Wall Street Journal article has some details on that. Frankly, you could just Google the cost of long-term care insurance, and you'll find it. Here's how we made that decision. The first thing I did was I looked into what does long-term care insurance cover. Now, of course, that's going to vary from policy to policy. But keep in mind that it's not unlimited. They'll give you some benefit, usually on a daily basis. That's the one I've seen, where it's some number, say some $100, $200, $300 a day kind of benefit for some number of years. Think 3, maybe 4 or 5, and then it ends. So it's not that this insurance policy is going to pay for your nursing home for as long as you need it. That is not how long-term care insurance works. And so what I did, and this was a few years ago now, I went in and calculated if I maxed out the benefit for one of these policies, what would it get me? What's the total dollars that this insurance company would pay toward my care or my wife's care or both of us? And then I just did an analysis. Can I self-insure? Could I handle that amount of money if we needed to? And my answer was yes. One of the ways I think about it is using the equity in our home, possibly. Also, I mentioned the HSA. We're saving up the HSA, and so we could have some money there as well. And so in our case, I decided it wasn't worth it. Now, I've talked to a number of people that have long-term care insurance. I get the family gatherings. People know I have this YouTube channel, and some want to talk to me about this. And so this comes up from time to time. In fact, I was talking to an aunt and uncle not that long ago. They have long-term care insurance, and they may be watching. So I'll say they're in their 70s, but maybe they're in their 80s. Anyway, one of the things they pointed out was, the premiums keep going up. It's not as if, get it when you're 55 and you're locked in and your premiums will never rise. No, premiums keep going up. And they've kind of found themselves in this situation where they've paid so much money into this policy, they don't want to let it go. And then need it a year from now and have wasted all that money. So they're sort of, I don't know that they feel trapped, but it's kind of like they're trapped into this policy. I don't think that makes long-term care insurance a bad thing for everybody, and maybe in their case it's a really good thing. But when I added all of those different things up, I just concluded that long-term care insurance wasn't for us. I think for those without a lot of money, they're going to just rely on Medicaid, which covers long-term care. And I think for some, and this viewer mentioned a net worth of $2 million, to me, that's kind of in that range where you're sort of thinking about it. Of course, it's going to depend on your age, and the viewer didn't give me their age. Might depend on your health history and your family history. Do you have a family history of different illnesses that might require long-term care? So there's going to be all these sort of individual factors that you're going to need to think through. But I think whether or not to get long-term care insurance for someone sort of in that range is probably one of the most difficult financial questions to answer. I certainly don't have some rule of thumb that I can give you other than calculating what the benefit would be and could you self-insure that amount, keeping in mind that wouldn't be your total cost, right? Because long-term care insurance doesn't pay for 100% of the expenses. I will say that when you find insurance companies that sell long-term care insurance, they love to tell you things like how much home care costs per day and how much a nursing home costs per day and the percentage of people that will need some form of long-term care. It can get pretty scary. I'm not suggesting we should ignore those things, but I think that's just one half of the story. We still have to look at what benefits the insurance policy will offer, under what circumstances will they kick in, and can you handle that burden on your own? If you can, at least for us, I've decided we don't need it, and that's my take on long-term care insurance. I think the market, the number of people that where it might make sense, probably not a lot. In this person's case, I can't answer that for them, but it's often for people that have are somewhere between can self-insure and want to rely on Medicaid. Again, whether that's you is going to just require some analysis based on your individual set of circumstances. Okay, last question. Should our investing strategy change as our wealth rises? I won't read this entire question, but they have several $1,000,000 from, I think, selling a business maybe. And at Fidelity, they've been recommending alternatives. And here you can see private equity, private debt, private real estate, venture capital, hedge funds. And one of the points they apparently make out is that there's an increasing number of companies have become private with limited choice for traditional investors. And so do we need to go for alternatives? And there's even this Fidelity site or webpage, and I'll link to it below. I'll give you my experience and thoughts on this. First of all, this idea that as your wealth rises, and there's no cutoff necessarily, but you need to start thinking creatively about your investments, I think is a very, very common approach on Wall Street. There's no way someone who goes with, I don't know, $5 million, $10 million, $20 million to a Wall Street bank and their wealth management services, I can guarantee you they're not going to say to you, you should invest in 3 or 4 index funds. No one at those banks has said that ever, okay? They're going to want to put you in pretty exotic and I think expensive investment vehicles, and a lot of them will likely have the words either private or alternative. Private debt, private equity, private real estate deals, non-traded REITs, and these sorts of things. I'm not here to say that those kinds of investments are always a bad idea. But I am here to say that I don't think just because you've got more money than the average person, you need any of those types of investments. I don't believe it at all. I think someone with $100 million would do very well in a handful of index funds. With that kind of money, could I see them just feeling a little better if they put some amount in some alternative investments? Maybe. Would it likely make them wealthier over time? I don't think so. But I can understand at that point, you've got so much money, it doesn't really matter unless you're just spending crazy amounts of it every single year. And so for me, these kinds of investments are sold, they're not bought. And that most individuals, even very wealthy individuals, we might call them high net worth or ultra high net worth individuals, simply don't need these kinds of complexities in their portfolio. They don't need these kinds of costs. Yes, there are fewer public companies than certain times in the past, but the fact of the matter is there are thousands of publicly traded companies, and that's just in the United States, and even more when you go international. And so there are plenty of options for investors to invest without needing to get into private debt and private equity. At least that's my take. So there you go. Those are the 5 questions for this week. Hopefully these answers have proven helpful to you. If you have questions, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.